Welcome everyone to FX Street. It's 2 p.m. Eastern, 1800 GMT, Wednesday, October 24th, 2012. Welcome back one and all. Great you could join us. I assume that you can hear the audio and video is coming through loud and clear. Dow Jones Industrial Average up 14 points at 13,116. S&P up 1 point. NASDAQ up 2 points. Excellent. 15 minutes from now, the FOMC, the Federal Open Market Committee, will meet during the regularly scheduled meeting, where they will most probably announce that interest rates will be left unchanged at the 0 to 0.25% level. Now we're going to chat in a couple things. This is as of 2 p.m. Eastern, which is right now. The 10-year U.S. Treasury bond pays a 1.7748, we'll call it 1.775% interest rate. The Dow Jones Industrial Average is up 14 points. Which currently leaves us at a level of 13,116. The dollar Swissy currency pair, 93.32, give or take half a pip depending on who your broker is. At 15 minutes from now, the Federal Open Market Committee will announce their interest rate decision, most likely to keep rates unchanged. Usually the changes from one meeting to another, the nuances are just simply that, just nuances. But we're going to judge the market's reaction to try to gauge what the market thinks of this next meeting. Now, what do we expect from the next meeting? We have to, in that case, go back to the previous meeting. Previous meeting took place on September 13th. That's when quantitative easing 3 was announced. I have a neat little trick that we're going to do today. We're going to instantaneously compare this statement, this month's statement, or this meeting statement, it's actually every 6 weeks or so, to last meeting statement. I have a nice little application, a little web page, that what it does is it compares text. I think it was originally created to make sure that students aren't plagiarizing each other's homework assignments. But what it does is you can post in 2 paragraphs or 2 entire statements, and it'll compare word for word. The reason why we can do this with a Fed meeting is usually almost all the words are exactly the same. In fact, sometimes the only difference in one statement to another, they literally copy and paste a statement and only change 1 or 2 words. They change their statement from being optimistic to tentative to concerned to very optimistic, and the market reacts based on those 1 or 2 words. You ever notice how traders sometimes know so quickly? The statement comes out in 1 second, and in 1 second the market already starts to move. Meanwhile, we have to read through 4, 5, 6 paragraphs to figure out, oh well, they said this and said that. But basically, yeah. The statement has the same layout and format more times than not. Here's a copy, here's the link, I should say, of last month's statements every 6 weeks or so. And what I'm going to do is just copy and paste this in to this little program that we have. It's a free website, and it'll compare instantaneously this statement to the last statement. Usually there's not a lot of big changes. Going back to the previous statement. What did we read? We're going to try to paraphrase here. This is from the September 13th meeting. Information received since the FOMC met in August suggests the economic activity has continued to expand at a moderate pace in recent months. Growth and employment has been slow. Unemployment rate remains elevated. Household spending continues to advance, but growth in fixed income investment appears to have slowed. I'm assuming that they're not going to change that language at all. Unless you think there's a reason. Growth in employment has been slow. The unemployment rate remains elevated. Now that the unemployment rate is now, where are we, at 7.8% versus we were at 8.1, 8.2 before, the statement was released. Do you think that they're going to change that particular wording? Has the unemployment rate, is it now not elevated? Or are they going to say, well, unemployment looks a little bit better? The housing sector has shown some further signs of improvement, albeit from a depressed level. Well, today we got some really good new home sale numbers. On a month-over-month basis, annualized 389,000 new homes were built in the month of, in the past month, in the month of, I guess, September, reporting in October. Now they estimate that if we were to build this amount of houses, this amount of homes consistently, we would build 389,000 homes for the entire year. I believe that's how it works. And if next month it's a little bit slower, they'll say, no, we're not going to build 389 for the year, we're going to build 379 or whatever it may be. But today's number represents, I believe, a 2-year high. Not since 2010 did we see the housing market show such good numbers. Although, talking about the housing market in 2010 is not exactly setting any records because it was still very bad at that time. Inflation has been subdued, although the price of some key commodities have increased. Well, now we know that commodity prices have started to come down a little bit. Longer-term inflation expectations have remained stable. Do we know anything about inflation? What's really cool is, let's go to the FX Street calendar. We'll select none. Then we'll select only US. We're going to select custom dates. Now, last meeting was September 13th, so we'll take September 14th through today, which is October 24th, and let's look at the medium to big size numbers. Notice what I did over here is I scrolled the little slider thing to the 2, including the 2 and 3. Then you hit the button, filter results. This is a link to the calendar, though. A really cool calendar by FX Street. And I'm not just saying that. It really is. Okay, so since their last meeting, these are the numbers the day after last meeting. Remember, what do they say about the housing? Okay, what do they say about inflation? Inflation has been subdued, although the prices of some key commodities have increased recently. We'll get to commodities. Longer-term inflation expectations have remained stable. Well, what about inflation? Whoops, there we go. Well, the day after the Fed met, remember they write the Fed statement, they write it, well before that meeting. It's not like they're writing the statement, 15 minutes before they're ready to announce it. The statement is prepared over the course of the month. Well, the next day, CPI was released, Consumer Price Index, year over year, 1.7% versus expectations of 1.6%. Definitely better than the previous month's estimate of 1.4%. I like the year-over-year figures, by the way. The month-over-month just seem too, inconsistent. CPI ex food and energy, so throw away commodities, food and energy. How much does the Consumer Price Index really, how has it really performed? 1.9% versus expectation of 2.0 and last month's estimate of 2.1. Interesting. So inflation, including commodities, has gone up. Inflation taking away commodities has gone down. So if you include, and this is from September 14th, so this is old data by now, but if you include the supermarket and the gasoline station, the gas station, inflation is going up. Things are getting more expensive. But I consider that bad inflation. That's bad inflation because most of us don't benefit from higher oil prices and higher supermarket prices. Most of us are not farmers. Most of us don't work for ExxonMobil, so that's bad. Good inflation is everything else. Good inflation means that if we work at a computer store and the price of computers goes up because the economy is improving, then we're going to get more money. We're going to, the computer store will make more revenue and we'll sell more cell phones and everybody's happy. So I would say September 14th's number was not good as far as a statement about the economy. Because the good inflation went down, which means our earnings went down, our salaries went down. The bad inflation went up. The bad inflation being gasoline and food and fuel. Okay. Since then, okay, so that's CPI. Talk about commodities. The price of gold is a pretty good indicator of commodities. Let's erase all these lines. Remember, last meeting was September 13th, so we'll draw a line here. September 13th is here. Where was the price of gold at this point? We closed that day at 1768. Since then, now gold's 1700. Now, this has really been a big surprise to those of us that expected QE3 to send the price of gold up. After all, gold went up after QE1. Gold went up after QE2. I heard an analyst, either it was today or late yesterday on Bloomberg, talking about the fact that, well, we don't know yet if QE3 is really working. We need to give it some time. We need to give QE3 about 6 months before we can really expect the stock market to go up and expect commodities to go up. It's too soon. I haven't looked at a day-to-day comparison. I have looked at comparisons between, in regards to how commodities and stocks have acted under QE1 and 2, and they went up. I don't remember exactly if they started going the day after or 2 days after, but QE3 was very highly anticipated. And everybody knows by this point, by the time QE3 was introduced, all traders knew about the correlation with gold and stocks. They said, well, if we get QE3, buy stocks and buy gold. Wouldn't you think, just out of the simple fact of the self-fulfilling prophecy, that if everyone was expecting QE3 and, well, maybe that's it. Maybe it was a case of buying a rumor, selling the news. But still, you would expect that commodity prices go up. If you had bought an ounce of gold, the closing price of quantity QE3 being announced, you'd have paid $17.68 an ounce. It's $1,700. They're losing $68 on a $1,700 investment. That's, 1%. Not a lot. But still, you're not making money. The price of oil. Crude oil is here. Erase all these lines. QE3 was announced September 13th, which is over there. If you had bought 1 barrel of oil and left it in your garage, you would have paid on September 13th's closing price $98.13 for a barrel of oil. Today, that barrel of oil would now be worth $85.60. 98 down to 85, $13.98. That's probably about 10% drop in oil since then. Well, going back to our Federal Reserve statement from last month, inflation has been subdued, although the prices of some key commodity prices have increased recently. Well, that's not true anymore. Longer-term inflation expectations have remained stable. Well, I don't know, stable is it's a very general word, but we know that from the CPI data the day after the Fed meeting, good CPI is not going up, it's going down. Bad CPI was going up, but that reflects obviously the commodity prices. Now we could say that bad CPI is coming down. Is good CPI going up at all? Or maybe it's still going down. Consistent with the statutory mandate, by the way, 2 minutes ago here, with the statutory mandate, the committee seeks to foster maximum employment price stability. The committee is concerned that without further policy accommodation, economic growth might not be as strong to generate sustained improvement, labor market conditions. Furthermore, strange global financial markets continue to pose significant downside risk to the economic outlook. The committee also anticipates that inflation over the medium term would likely return at or below its 2% objective. Where was inflation last CPI? 1.7%, including commodities. Without commodities, 1.9%. They have a 2% target. They said in their own words, at or below 2% objective. And that was their justification. Bad employment, they haven't talked about GDP yet, but bad employment figures and inflation below 2%. If we don't have inflation at 2%, then what's the point? We need QE3. Let's go back to the dollar Swiss. I'm going to go to a 5-minute chart just so we can kind of watch the market trade as this announcement is being released here. About 60 seconds ago, but sometimes a little early, so we'll keep the chart up. If anybody gets the announcement before I do. let us know over here. It's 2:15. Let's go to our economic calendar. Whoops, that's not it. Unchanged. Oh, you know what I want to do? Okay, I almost forgot. All right, so this is the statement for October. Okay, now I'm not listening to Bloomberg News, so I have no idea what the analysts are talking about. We're flying on our own over here. This is, I'm going to copy and paste the September 13th meeting. Copy. I'm going to put it into the first fragment paragraph, which is over here. I hope I can fit the whole thing. Warranted is the last word. Warranted is last word. Okay. So that's last month's statement. This is this month's statement. Copy. I'm going to put it into the second window. Warranted is last word also. Press compare. Now let us just compare to see what text is different. Okay, information received since the FOMC met in September. They changed the word from August to September. That's good. Suggests the economic activity has continued moderate pace. Growth and employment remains elevated. They said, last month they said household spending has continued to advance. This month they said household spending has advanced a bit more quickly. Okay, so let's keep track of this stuff. Okay, so continued. Oh, well, I'm going to define what it is. Household spending continued to advance, and now they said advanced more quickly. Take a look at the dollar, by the way. For some reason, the dollar really likes this statement. We're going to find out. Advanced more quickly with growth in business investments. They said last month appears to have slowed, has slowed. Growth in business fixed investment. That's business, I'm abbreviating. Okay. Last month they said appears to have slowed. This month has slowed. So now we know for sure that business and fixed investment has slowed. I tell you, there's not a lot of really big changes. It actually makes it kind of easy. Last month they said inflation has been subdued, although I should just copy and paste this in, make it easy. Although the prices of some key commodities have increased recently. Can I copy here? Yes. That was last month. That's this month. I'm pasting in last month's first. Okay, so last month inflation has been subdued. All the prices of key commodity prices have increased recently. Inflation recently picked up somewhat, reflecting higher energy prices. I don't know. I don't see the energy price. I thought oil went down. Second sentence. Consistent with statutory mandate, they said the committee is concerned, and now they said the committee remains concerned. Well, there's actually more to it. They said the committee is concerned that without further policy accommodation, economic growth might not be strong enough, etc. Last month they said that. This month they said the committee remains concerned that without sufficient policy accommodation, economic growth might not be strong enough, etc. As I'm watching the dollar in the background go to the moon. Third sentence, I promise this won't take long. to support stronger economic, etc. The committee agreed today to increase policy combination by the purchase of additional agency debt, so on and so forth. Today, they said the committee will continue to purchase additional agency debt. So their stance in QE3 has not changed. Last month they said holdings. Okay. To extend the average maturity of its holdings of securities as announced in June, and this month they said holdings of Treasury. We don't have to include that. We know that. Oh, that's not QE3. I'm sorry. That is what's it called? Operation Twist. Okay, so that has not changed. The fourth and fifth sentence, no change. Here. Last sentence, they're talking about the members who opposed it and who liked it. Whoops, I know that's a lot. Sorry, we'll try to do that again. Disregard that last post of mine. Voting against the action was Jeffrey Lacker, who opposes additional asset purchases and preferred to omit the description of the time period of exceptionally low levels for the federal funds rate to be warranted. I agree with Mr. Lacker, by the way. But unfortunately, I don't think he gets a vote this year. Hopefully next year he will. So that's what they said last month. The difference is this month, they said this. Voting against the action was Jeffrey Lacker, opposed. Jeffrey Lacker still opposes it. Omit the description of the time period, which a highly period which exceptionally low levels for the federal funds rate are likely to be warranted. And this month he said monetary policy remain appropriate and exceptionally low levels. Okay, so that hasn't really been. Jeffrey Lacker still opposes it. Okay, so let's go back to my notes over here and see what differences they've made. And I know that I probably missed a couple comments and questions as well. Bill Gross announced that he will stay clear of U.S. Treasuries. I agree. I think that there's more value in other places. I think the Fed rather sees inflation up a bit better than deflation. At least I can sell my ounce of gold to cover my individual financial shortfall. Hopefully before gold goes down more. QE1 pushed gold at 50%, QE2 about 20 some odd percent. Additional QE3 introduced us to inflation. Well, that's the idea. And I do think inflation is here. I think it's here to stay. I just don't know if it's going to be so simple as gold. That's the problem. Take a look at this is a 5-minute chart of the price of gold. Initial big move up, but then a reversal to the downside. Here is, in fact, let's do this. Sorry, I'm all over the place here. Okay. So, top left-hand corner, dollar Swissy. Bottom left-hand corner, gold. So we can see the reaction. And then Dow Jones Industrial Average we'll put over here. Gold. We have room for one more. Oil. Okay, beautiful. So we have the commodities at the bottom and the financial markets at the top. All 5-minute charts. So this is the initial reaction. Dollar Swissy immediately has a spike down, turns sharply higher. It looks like it's trying to make those new highs again. Gold has an opposite reaction, immediate spike up, and now red candlestick. Oil, a little bit of a spike up and kind of flat. Oil doesn't really know what to do with all this yet. It's not as weak as gold. The Dow Jones Industrial Average, interestingly enough, is going in the opposite direction of the dollar, which is what we would expect. Let's go back to the notes and try to figure out why. Okay, so we said last month household spending continued to advance a bit, and this month advanced a bit more quickly. Household spending is starting to advance. They said last month growth in business fixed investment appears to have slowed, and now this month they said it has slowed. Okay, so far that's not a really big deal. Household spending. They're saying household spending has advanced more quickly. That's the first key point I would say. Inflation has been subdued, although some key commodity prices have increased recently. They said that last month. They said inflation now is picking up because of higher energy prices. But I would argue, I don't know necessarily, okay, when they say energy, if they're talking about the price of oil, I would disagree. If they're talking about the price of gasoline, that's a different story. But then again, the Fed can't really take credit, not that they would want to, but they can't take credit for the high price of gasoline. There's a big difference between oil and gasoline. Oil comes from the ground. Gasoline is a result of how expensive it is for us to refine it. If you remember this past month, there was a story out of California, gas prices hit all-time highs, $5, almost $6 a gallon. Oil wasn't hitting necessarily all-time highs, but gasoline was. Why? Well, a few different reasons. One being that there was a pipeline taking the gasoline from Northern California to Southern California. That broke, and California can't buy their gasoline from outside the state of California because it's got this very green energy, very clean type of gasoline. I don't know exactly what the difference is, but that's so they can only buy gasoline from within the states. Well, as a result, price of gasoline went up. A little bit to do with QE3 and the Fed, but not really entirely. Okay, so the price of commodity price is not necessarily, I would say, skyrocketing over the past 30 days or 45 days. Okay, so they said committee is concerned that without further policy accommodation, economic growth might not be strong enough. And this month they said committee remains concerned. They were concerned, and they remain concerned. Committee agreed today to policy accommodation by purchasing additional, so on and so forth. They're talking about Operation Twist. This month they said the committee will continue to purchase additional mortgage-backed securities. I think it's $40 billion a month is what the statement says. Last month they said opposed additional. Okay, so sorry. Okay, so voting against it was Jeffrey Lacker, and that was the same. Okay, so what's the big difference? Not really a lot. Operation Twist is still on the table. QE3 is still on the table. The only really big difference I can see, correct me if I'm wrong, I'll give everybody the links to all this stuff, is that, well, number one, they said, it was actually the first point, household spending continued to advance, but a bit more quickly. I'll recopy and paste this in. This was this month. A bit more quickly. And then they talked about inflation being subdued, although the price of some key commodities have increased. And this month they said inflation has picked up somewhat, reflecting higher energy prices. Did that go in? There we go. That's really the only big differences I can see. I'm really curious to see if the economists, the talking heads on Bloomberg are picking up on something else. If anybody happens to be listening to Bloomberg or any of these financial news networks, and they're saying something that I don't see, I would like to know. This is from a Dow Jones news tape. I'm getting some bullet points here. Fed sticks to hit its mid-15, $40 billion of mortgage-backed securities a month. Employment growth slow. Can I copy these in? These are bullet points. No, I'll copy and paste them all in at once. Okay, so they said stocks have dipped, but not much going on in bonds. Notes inflation pick up on energy, but it sees it at or below 2% medium term. The statement leaves markets with big issues to be decided later. Job market still key. Okay, so what's new with that? So everybody knows the job market's still key. Let's take a look at, remember our commodity, we took a look at where the commodities and everything were before the meeting. Okay, so this is what we said before the meeting, and I'll paste it right in. I'll paste it back in, okay? So this is where the indices were before. The indices is what I'm looking for. Okay, so now, U.S. 10-year bond yield, 1.7748%. What did we say before? It was 1.775. It was actually 48. I was rounding up to 5. 10-year bond has not, I'm sorry, 1.77, no, it's 7748. The bond market hasn't moved. The Dow Jones Industrial Average was 13,116, now 13,124. Big deal, up 8 points. That's nothing. Dollar Swissy was 93.32, and now dollar Swissy 93.31. The Dow is up 8 points. The dollar Swissy went down 1 pip. I think it's official. There's no market reaction. QE3 will continue at $40 billion per month. No change there. Exceptionally low rates through mid-2015. Economic activity has continued to expand at a moderate pace. Inflation recently picked up somewhat, reflecting energy prices. Household spending has advanced a bit more quickly. Further signs of improvement in housing. We know that from today's number. Employment has been slow. There is some divergence in headlines here. Bloomberg saying Operation Twist will continue through the end of the year, and Reuters saying it's all over at the end of the year, which, isn't that the same thing? Bloomberg saying Operation Twist will continue through the year end. Oh, meaning maybe past. Past. As far as I know, and I haven't heard any differently, that Operation Twist is supposed to end at the end of the year, conclude at the end of the year, and wind down beforehand. By the way, that's this month's statement that we just got a few minutes ago. And that was last month's statement. So if you have trouble sleeping and you want to read something that's very soothing, here's 2 policy statements. Does the Fed change its policy? Any effect to short-term movement in 2 weeks? It's a great question. I mean, will the Fed make any changes in the next 2 weeks? And I'm assuming you're saying 2 weeks because we have elections coming up. I doubt it. I doubt it because although the Fed is supposed to be completely neutral and not attached to any politician or any, we know that's not really the case. But, it's not even something like that. I mean, I just don't think that the conditions warrant such a change. I mean, you have to have such a justification. The Fed has to say, on October 24th, unemployment was at 7.8%, and 2 weeks from now, unemployment dropped to 5%, and October 24th, the GDP, the last estimate was 1.3%, now we have 5% GDP. The economy has doubled in the past 2 weeks. We better conclude Operation Twist. We better start raising interest rates. I mean, I'm of course exaggerating, but you have to have the only time I've seen intra-meeting changes is when the economy changes so fast that the distance from one meeting to another is just too long. Remember in the financial crisis, 2008, the Federal Reserve cut interest rates, And then, and the European Central Bank cut interest rates. But then the economy started to slow down so fast that the Fed says, we don't want to wait for the next meeting. Let's cut rates again a month after or 3 weeks after. But you need that kind of velocity in the economy, that kind of massive change in a short period of time to warrant that. I don't see the Fed changing anything. I think that, and I don't think this is an accident. I think that the Fed on purpose is a very slow-moving, very boring kind of, agency, because that lack of change helps create stability in the markets. I mean, when the Federal Reserve increases interest rates by a quarter of points, for us, big deal. Okay, so I'm not getting as much in my carry trade when I buy the Kiwi dollar, when I buy 1 mini lot of the Kiwi dollar, making $1.50 and not $1.75, or whatever it is. But, for banks, financial institutions, home lenders, those billions and billions of dollars in the economy that goes back and forth from one to another, credit cards and everything else, a quarter point is the whole world. I mean, imagine, from the height of the financial peak in 2007, interest rates in the U.S. were 5.25. Now, for all intents and purposes, we're either at 0 or 0.25. We've only moved 5 percentage points from the top of the best economy to the bottom of the worst economy. I don't know, absolute best, but very, very hot markets to a very, very bad market. It's only 5 percentage points, 500 basis points. So how many quarter points? There's 20 incremental quarter point moves. Actually 21 if you go from 5.25. So, and that's each, so let's say 20s, that's 5%. Each quarter point move is 5% adjustments in their total interest rates. In order to adjust a business, imagine if Apple Computer says, you know what? We figure out a way to make an iPhone, and we're going to be able to sell it, not sell it for 5% cheaper, because that doesn't matter so much to us, but we're going to be able to produce 5% more iPhones for the same amount of price. I mean, that is 5%. That is going to come up in their earnings big time. If an economy is improving at 5%, we have U.S. GDP right here at 1.3%. If our GDP went from 1.3 to 6.3, up 5%, that would be unbelievable economy that we would never stop talking about. 5% is a lot. So, and I'm talking about a 5% change, meaning that if we move from 0% interest rates to 0.25% interest rates, assuming 0 is the bottom and 5% is at the top, moving a quarter point, which is 1/20th of 5%, that's big. So, point being, I would not expect any change at all, because even a quarter point is actually huge. Judging by the dollar Swiss 5-minute chart, it looks like the trading algorithms got confused by comparing the two statements, just like I did. You're right. I don't think the algorithms got confused. I think the algorithms just sort of said, no, well, buy, no, I'm not going to sell, no, I'm not going to do anything. Nothing's happened. There's nothing really new to report. I mean, that's the end of it. That's the long and short of it. That the business, how do they put it? The business and fixed investment has improved a bit. They use the word a bit. These are the sharpest economists in the world. They're using words like a bit. Inflation, energy, we know. Okay. But, I mean, that's about it. Interesting, though. That's not all I have to say. This was from the Bank of Canada. It's funny that when big news in the U.S. comes out, you can have really, really big news come out in Canada, but everybody seems to ignore it. And sometimes the news in Canada is a lot better reading. This is from their statement today. A key reason for the near-term upgrade is stronger U.S. growth. The bank's annual U.S. projection was lifted by 0.2 points for this year and in each of the next 2 years. The bank believes QE3, this is what the Bank of Canada believes about us. They're talking about us. The Bank of Canada believes QE3 will give the U.S. economy some traction, adding 1.3 percentage points to U.S. GDP by 2014, and in tow, 0.4 percentage points to the Canadian GDP by 2014. So they're going to ride our QE3 coattails, which is okay. The domestic economic outlook, final domestic demand, was actually shaved back a bit despite the bank's past criticism of Canadian businesses not embracing non-U.S. trade enough. It's U.S. trade that the bank is betting will produce better Canadian growth. Note that the positive growth effects of QE3 for Canada are offsetting the negative for growth currency effects, meaning a stronger loonie, which means basically, okay, QE3 in the U.S., we being Canada, now I'm Canadian, okay, that we, Canada, believe that QE3 is good for the U.S. and it will improve the U.S. GDP by 1.3 percentage points. And by the way, U.S. GDP right now is only at 1.3. So they're thinking we're going to go from 1.3 to 2.6. And they're going to say it's going to be so effective over there in the U.S. that over here, it's also going to give us another 0.4 percentage points for our own GDP, and that's good. But don't expect as much growth because remember, as our growth gets stronger, our currency, the loonie, the Canadian dollar, goes up. And as that currency goes up, all of a sudden those Canadian businesses that export to the U.S., all of a sudden they're going to run into a problem of having a strong currency to contend with, and that's going to slow it down. And by the way, that's why the dollar-CAD pair is such a range-bound monster. Goes up a little, down a little, up a little, down a little. It's because our two economies are so closely tied. Now, somebody will say, well, what about the price of oil? And that's true. Price of oil goes up. Price of oil goes up $50 a barrel. You'll definitely see the dollar go down and the Canadian dollar go up because higher price of oil definitely do benefit the Canadian economy. But that's macroeconomic kind of stuff. Small term, dollar for dollar, pip for pip, I don't believe that there's any kind of correlation. I don't think that for every 10 cents that the price of oil goes up in the U.S., that the dollar-CAD will go down by 10 pips. I don't believe that's the case. Sure, there are algorithms out there that have tried to identify that correlation, and then they try to buy low and sell high, and they've smoothed out, they've basically destroyed any kind of correlation in their own efforts to make money. Okay, how much time do we have? We have 3 minutes left. Questions, by the way, if I missed anybody, please remind me. What do I think moving forward? I think that, we talked about this during a recent webinar here in FX Street. Yesterday? Was it yesterday? Yeah, I think so. Looking forward to the end of the year, I don't think the Fed's going to do anything different. It's slow and steady, smooth sailing. We're not going to make any waves at all. Operation Twist is on through the end of the year, maybe further, but so from what I've heard, only through the end of the year. Quantitative easing 3 is on the table and active until, as far as the Fed says, employment is much better and that U.S. and inflation is above 2%. But they said there's no limit to QE3. We're gonna keep our foot on the gasoline as long as it takes. Now, what I find really curious is the fact that QE3 just happens to be not affecting the stock market and gold and commodity markets like we would have expected. But I would argue, take a look at the price of gold before QE3 was announced. I call that buying the rumor, selling the news. The price of gold priced in QE3 and then some. Take a look at the price of the dollar coming into QE3. QE3 again is that white line, the vertical line. I would say the dollar already priced in QE3 and then some. Let's say, I'll make up a number, but let's say that the dollar's fair value considering QE3 was probably over here, they're 95.40. I don't know, I'm making it up. That's where the dollar, if we did the math, actually should have been. But all the sellers got so anxious about QE3, expecting something great, they oversold the dollar. The other thing is this. Operation Twist. Operation Twist, if I remember the Fed statement correctly, is 40 billion a month, right? QE3 is about 45 billion a month. Is that right? I'm guessing the numbers. I think I'm right. But Operation Twist will end at the end of the year. QE3 is buying mortgage-backed securities, MBS, mortgage-backed securities. QE2 bought, I believe it was 75 or 85, let's give it the benefit of the doubt, 75 billion a month. QE2 bought treasuries, long-term treasuries. So we see here the difference. QE2 was definitely, in my opinion, a lot more of a potent solution, a lot more aggressive. Operation Twist, okay, that's 40 billion, and then QE3, that's 45 billion, but basically take Operation Twist off the table because we're almost done. I mean, one more month. And I think that I read that they're slowing down. They're not buying as much as they were before. So now we got QE3. We have to compare $45 billion a month they're buying of QE3 versus $75 billion a month of QE2. And QE3, they're buying mortgage-backed securities, which I guess is great if you're directly involved in the housing market, but not so good if you're not involved in the housing market. Because you're buying mortgage-backed securities, which is basically a fancy way of saying we're buying the bad debt away from the banks. The banks don't want to lend. Well, it must be because they own too many bad loans. Let's buy those bad loans away from the bank, clear the bank's balance sheets, and then they'll be off to the races. I think this will be really good for the bank's balance sheets, though, by the way. I think the banking stocks might really like this kind of stuff. But also, remember the reason why the dollar went down so much and gold went up so much because of QE2? It wasn't because of the buying of the treasuries, it was because of the printing of the money. They printed so much new money, it diluted the dollar. They were printing $75 billion a month during QE2. Operation Twist, they're not printing any money. They're buying long-term treasuries, but they're selling an equal amount of short-term treasuries. It's a net neutral kind of quantitative easing. They're not printing any money. So take 40 billion off the table. So basically, you have 75 billion a month of printing new money. They were printing new money in QE2 versus 45 billion a month. They're printing half as much money as they were in QE2, roughly. So, and plus the fact that, I think for a lot of us, the fact that the dollar went down so much, it took us more by surprise in QE2. Now we have a case where everybody was expecting a weak dollar, and maybe a lot of us were expecting QE2 again, another 75 billion a month. That's why when QE3 was announced, the day it was announced, and we read, I believe it was actually here in FX Street, we read the statement. I said, it's not QE3, it's QE3 light, diet QE3, diet quantitative easing, because they're not buying treasuries, they're buying mortgage-backed securities, and they say, well, we do have Operation Twist, but Operation Twist is almost over. So what do we have left? 45 billion, which is less than I think probably a lot of us expected, 75 or 80 billion a month. So that's why I call it diet quantitative easing. It's less filling but tastes great. With that said, I'm out of time. If you have any questions, you can contact me directly. www.forexlounge.com. I want to thank you all very much for joining us. Very special thanks to FX Street. Please see the calendar because we have more on the table. Again, we thank you for joining us. We wish you a great day, all profitable trades, and we look forward to seeing you back soon. Back inside FX Street.